The financial world often speaks in a language of certainty. We're told to diversify, to chase growth, to follow the crowd, to believe that the path to wealth is a well-trodden, clearly marked highway. But what if that highway is, in fact, leading many astray? What if the conventional advice, the wisdom passed down through generations, is actually a series of well-intentioned but ultimately flawed shortcuts? Today, we're going to step off that paved road and venture into a landscape where true wealth is built not by following, but by understanding. This isn't an exercise in contrarianism for its own sake. It's about peeling back the layers of popular financial dogma to reveal the fundamental truths that the market, in its noisy, short-term frenzy, often obscures. As Benjamin Graham, the father of value investing, so wisely observed, the market acts as a voting machine in the short term, swayed by popularity and fleeting sentiment. But in the long run, it becomes a weighing machine, accurately assessing intrinsic value. We'll explore how clinging to the votes of popular opinion can lead us to overvalued assets, while true, sustainable wealth accumulation comes from diligent analysis and a focus on that enduring weight of inherent worth. Our journey today is a roadmap. It's designed to equip you with a more discerning eye, a critical lens through which to view the constant barrage of financial information. We'll challenge the obvious to uncover the deeper currents that shape genuine financial prosperity. By the time we conclude, you'll have a clearer understanding of market realities and the courage to make investment decisions that are rooted in data and enduring principles, not in fleeting trends. This is about redefining your financial future beyond the superficial pronouncements and into the realm of informed, strategic action. Let's begin by challenging one of the most pervasive pieces of financial advice, the dogma of diversification. We're often told that to build wealth safely, we must spread our capital far and wide, owning a little bit of everything. But the data, when we truly examine it, often tells a different story. Excessive or uninformed diversification can become a diversion from the very opportunities that create substantial returns. It can lead to what some call diversification, a dilution of high-conviction investments that, when properly researched, can significantly outperform a homogeneous, mediocre portfolio. Consider the index fund, often hailed as the pinnacle of diversification. While it offers broad market exposure, it also means owning companies that are overvalued, poorly managed, or lack any real competitive advantage. It's akin to owning a vast orchard where many trees yield poor fruit, yet you expect the harvest to be exceptional. The truth is, a carefully curated selection of truly outstanding businesses, those with deep economic moats and trading at a compelling discount to their intrinsic value, can deliver superior long-term results. This idea challenges the narrative that safety lies solely in sheer breadth. The myth that you must own everything to be safe often serves the interests of those selling financial products more than the investors themselves. It preys on a psychological desire for safety in numbers, a comfortable mediocrity that can inadvertently stifle genuine wealth creation. True financial literacy demands that we look beyond this comforting illusion. Instead, we must focus on what I call intelligent diversification. This means concentrating capital in businesses we understand profoundly, businesses that possess durable competitive advantages, and crucially, businesses that are trading at a significant discount to their true worth. This is not about owning two of every stock like Noah's Ark, but about identifying the few champions and giving them the space to flourish, a principle that resonates deeply with the wisdom of Warren Buffett. The siren song of passive income is undeniably alluring. We envision money working tirelessly for us, generating wealth while we enjoy the fruits of our labor. But this promise, more often than not, masks a continuous, often unacknowledged effort. True passivity in income generation is a rare, almost mythical creature. Whether it's managing rental properties, meticulously analyzing dividend reinvestment strategies, or overseeing online ventures, what is presented as passive almost invariably requires active oversight, constant adaptation, and recurring investment of both time and capital. Consider the analogy of a self-watering plant. It sounds effortless, doesn't it? But scratch beneath the surface and you'll find its reservoir needs refilling, its leaves require pruning, and its soil must be regularly checked for health. This, in essence, is the reality of most passive income streams. Rental properties demand tenant management, maintenance, and market monitoring. Dividend stocks require analysis of company health and payout sustainability. Even REITs, while seemingly hands-off, are subject to market fluctuations and require careful selection. This allure of effortless income creates a psychological trap. The sheer cognitive ease of believing money is working for me can lead to a dangerous over-optimism, a tendency to underestimate the ongoing demands. This gap between expectation and reality can result in neglect, allowing what was once a robust income stream to gradually wither. Therefore, a critical strategy emerges. Define your personal active effort threshold, understand precisely the time and capital commitment each supposed passive income stream truly entails. Focus focus on those where the active component aligns with your capacity and goals, or develop a systematic approach to outsourcing that active management, always coupled with rigorous oversight. For true compounding, as Warren Buffett so often emphasizes, is not merely about letting money sit. It's about the continuous learning and strategic allocation of capital that arises from understanding the entire ecosystem, not just the seeds you've planted and walked away from. The allure of market timing is a powerful siren song, promising riches for those who can perfectly predict the market's ebb and flow. Yet, statistical analysis overwhelmingly confirms that consistently timing the market is a near impossible feat, even for seasoned professionals. The cost of even a few wrong guesses, missing critical rallies, or being caught in sharp downturns can profoundly erode potential gains. This pursuit distracts from a more reliable truth. We must distinguish between the volatile market and the stable business. The market is a creature of sentiment, driven by noise and emotion. A business, however, possesses intrinsic value rooted in its earnings power and assets. Trying to predict the market's daily mood swings is like predicting a decade's weather with precision. It's far more effective to focus on the enduring fundamentals of a business, its capacity to remain resilient through various economic conditions. While it's true that markets tend to recover over extended periods, the interim can involve decades of stagnation or severe capital loss. This period of underperformance can cripple the compounding effect essential for wealth building. This myth of inevitable recovery often downplays the devastating impact on investor psychology and long-term financial goals. Instead of market timing, embrace valuation timing. This means focusing on entering the market when exceptional businesses are offered at a significant discount to their intrinsic value, a core tenet of Benjamin Graham's value investing philosophy. Learn to calculate a business's true worth and buy with a margin of safety. This is akin to becoming a skilled observer of an underwater ecosystem, patiently waiting for the perfect opportunity, the undervalued stock, to appear. Rather than futilely guessing when a specific whale will breach the surface, the mantra of buy and hold is often presented as a foolproof path to wealth, a set it and forget it strategy. However, its true effectiveness hinges on a critical, often overlooked prerequisite: holding quality assets. Applying buy and hold to a mediocre or fundamentally declining business is not a strategy. It is a recipe for prolonged underperformance, a passive resignation to mediocrity. We must scrutinize this advice, recognizing that holding a company indefinitely simply because it's labeled buy and hold can be akin to financial negligence. Consider the profound difference between owning a well-constructed castle and a dilapidated shack. A buy and hold strategy applied to a business with a robust economic moat, ethical and competent management, and a consistent history of earnings power is indeed a wise approach. Conversely, applying it to a shack that's slowly crumbling, its foundations eroding, is a fundamental misunderstanding of ownership. The enduring businesses, those with deep competitive advantages that withstand the test of time, are the ones worthy of a long-term holding period. Those that lose their competitive edge, however popular they may once have been, are not. This leads to a powerful psychological trap, anchoring bias and inertia. Investors can become so emotionally attached to their initial purchase, to the idea of the company they bought years ago, that they ignore deteriorating fundamentals or crucial new information. The persistent hope that it will eventually recover, despite mounting evidence to the contrary, is a potent cognitive bias. This is the sunk cost fallacy applied to our portfolios, continuing to invest time and capital simply because we've already invested it. Therefore, an actionable practice is essential. Implement periodic business reviews. Treat your investments not as abstract stock tickers, but as direct ownership stakes in real businesses. Conduct regular, perhaps annual or semi-annual, reviews of their competitive landscape, their financial health, the quality of their management, and their long-term prospects. Be prepared to act to sell if the fundamental thesis upon which you bought the business is demonstrably broken. As Benjamin Graham himself stressed, buy and hold is not a passive strategy, it demands vigilant oversight. It is about holding sound investments through market fluctuations, not holding any investment through fundamental deterioration. This is the crucial distinction between being a shrewd owner and a hopeful gambler. The conventional wisdom often equates risk with short-term price fluctuations, with volatility. The financial media thrives on this narrative, highlighting daily market swings as the primary measure of danger. However, for the discerning investor building sustainable wealth, this is a profoundly misleading metric. The true risk, the one that erodes fortunes and shatters financial dreams, is the permanent impairment or outright loss of capital. This is rarely caused by a temporary dip in stock price. It stems from compromised business fundamentals, outright fraud, or shifts in the economic landscape so profound they render an investment worthless. Many strategies focus on hedging against volatility, a complex and often expensive endeavor. This is akin to buying a state-of-the-art umbrella to shield yourself from a downpour, while ignoring the fact that your roof has developed a gaping hole. The real problem isn't the temporary rain volatility, it's the structural integrity of the roof itself, the fundamental health of the business you've invested in. The oft-repeated adage higher risk, higher reward is only valid when the risk is properly calculated and the potential reward is commensurate. Uncalculated, permanent loss risk offers no reward, only ruin. Consider the stark contrast between highly volatile, yet fundamentally sound, compounding businesses and speculative bubbles that inevitably burst, leading to the irreversible loss of invested capital. Our actionable approach must therefore shift focus. We must assess investments based on the probability of asterisk permanent capital loss asterisk. This requires deep dives into business models, the durability of their competitive moats, the integrity of their management, a critical examination of their accounting practices, and an understanding of macroeconomic forces. It's about discerning the difference between a temporary price dip and a business in terminal decline. Think of it this way: volatility is the ocean's waves. Permanent capital loss is the ship sinking. A well-built ship can navigate rough seas, but a poorly constructed one will founder, regardless of the wave size. The focus must be on the integrity of the vessel, your investment, not merely on predicting the waves. We've journeyed through a landscape often clouded by conventional advice, yet illuminated by deeper truths. The 8 principles we've touched upon: challenging the dogma of diversification, understanding the active nature of passive income, distinguishing valuation timing from market timing, recognizing that buy and hold requires due diligence, and redefining risk beyond mere volatility, are not simply contrarian opinions. They are grounded in the bedrock of data, etched by historical precedent, and forged in the crucible of market psychology and rigorous business valuation. Our aim has been to guide you from a place of passive hope, from the comfortable but often flawed embrace of widely accepted wisdom, to a position of active knowledge. This is about cultivating a mind that prioritizes critical analysis and data-driven decision-making over the echoes of popular narratives. It's about understanding the why behind every investment, not just the what. As Warren Buffett so eloquently puts it, our favorite holding period is forever, but this forever is not a blanket endorsement of inertia. It is a declaration of conviction, reserved for businesses that have earned that designation through rigorous selection, through a deep and unwavering commitment to understanding their intrinsic value and enduring competitive advantages. It is a forever built on knowledge, not on blind faith. Your next step is to integrate these truths into the very fabric of your investment process. Continuously question the conventional wisdom that surrounds you. Prioritize deep, fundamental analysis. Build a portfolio that reflects genuine understanding and conviction, rather than chasing fleeting trends or succumbing to the allure of easy answers. The path to sustainable, meaningful wealth is not paved with simple slogans, but with informed skepticism, strategic conviction, and the courage to look beyond the obvious. It is a path you are now better equipped to navigate.